Hello there. Welcome to The Open. Happy Friday. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. The Canadian economy added more jobs than expected last month. Data from StatsCan indicates that the labour market added 8,200 jobs in December, beating expectations. The gains were led by full-time employment, mostly in healthcare and social assistance. However, the unemployment rate rose to 6.8%. Aritzia posted higher profit in its latest quarter, as well as revenue that topped Bay Street expectations. In fact, revenue jumped 43% year over year to just over $1 billion. Same-store sales were higher across all categories. The clothing retailer says the results were driven by higher U.S. sales, digital initiatives, and marketing. Aritzia also raised its full-year sales outlook. Glencore has confirmed it's in talks with Rio Tinto on a possible merger. This comes a little over a year after earlier talks between the two collapsed. The mining giant says both companies have been discussing a potential combination of some or all of their businesses, including an all-share takeover. Bloomberg says Rio is open to retaining Glencore's coal business if talks are successful. Glencore says Rio must announce an intention to make an offer by February 5th. And it looks like we are going to get a higher open on the U.S. market. In fact, we could get the S&P opening in record territory today. The U.S. market, closed yesterday slightly down from its record high of earlier this week. Let's have a look at the TSX. It too is trading near a record high that was posted earlier in the week. And of course, we'll get Canadian stocks taking another run at record highs today. Let's have a look at oil. And you can see oil actually up slightly, even though there's the prospect of more Venezuelan crude coming on the market. Let's have a look at gold, because gold has been under a little bit of pressure this week, but you can see not far short of record highs, trading right now just below 4,500. And let's have a look at the Canadian dollar, and it's holding its own against the US currency, slightly weaker. And finally, Bitcoin. Bitcoin has Bitcoin down. That's interesting. It managed to get its head above the $90,000 level, but under a little bit of pressure right now. StatsCan says the economy added 8,200 jobs in November. Not that many, driving the unemployment rate up to 6.8%. In the U.S., hiring slowed in December as employers added an estimated 50,000 jobs. Let's get more from Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, thanks very much indeed for joining us. Start off with the Canadian job numbers. What was interesting there?
Yeah, what was interesting is that is what I call puzzlingly positive. You know, we continue to get good job numbers out of Canada, which from our team's perspective, we're still looking into in regards to what are the true drivers, because our view is that Canada will underperform the U.S. And there's so much uncertainty. It's not an environment where you typically see job creation, but we are seeing it, especially on the full time. And we're surmising that the reason is the U.S. is doing very well growth-wise, continues to do very well growth-wise, and this is some of the side effects of that.
The Canadian job numbers, when you look at job numbers, monthly job numbers, Earl, do you tend to group them to, I mean, obviously there's swings in any given month. Do you look more at a 6-month average, or how do you handle these numbers?
Yeah, so we look at the trend. So what's that trend? Is your 6-month average higher than your 3-month average? What is it from month to month? So we definitely do that to try to smooth it out. And the trend is definitely positive from a jobs perspective, which is good from the economy, which is good for people being able to spend, people being able to pay their mortgages. So that's strong. And it kind of falls into our view that Canada will muddle along from a growth perspective, still have positive growth, but not quite as positive as the U.S.
There was an expansion of the labor force, more than 80,000 in December. Is there any particular reason why that would have happened? I know it's just 1 month.
Yeah, no, you know what? I think it's just people, in regards to hiring, we do know there's hiring in the restaurant industry per se. They've been understaffed. I think it's just a comfort level in regards to hiring. We're past at least peak tariff uncertainty. Yes, we have CUSMA to deal with this year, but at least from a retail and restaurant perspective, we feel that people are more comfortable going into the market looking for those type of jobs and looking for jobs in general. So that's positive. That's why the unemployment rate increased to 6.8, but it was due to participation. So that's a good reason for the increase as opposed to lower jobs.
Turn to the U.S. market, if you would. The U.S. employment numbers. Traders seem convinced that there won't be an interest rate cut from the Fed this month.
Yeah, we fall in that camp as well. One of the things, the news, lower employment or, having less jobs than expected is usually positive for cuts. But what we also saw was higher wages. They were expecting 3.6% increase in wages. We got 3.8. So that kind of speaks to the underlying inflationary tone. So we think feeling employment will keep the Fed on neutral, but growth will keep it on neutral as well, too, for now at least.
And America essentially has easy credit conditions, though. It's easy for companies to borrow, for example.
Yeah, what I would say is two things. One is obviously their interest rates are lower than they were last year, so it's cheaper for companies to borrow. And by the end of this year, they will have what we will call easier credit conditions. And the reason why I say by the end of this year, what's expected in the U.S. this year is bank removal of some of the bank regulations around capital. So what that does is it gives banks more money to lend, and then there's a multiplier effect on the economy from that. So they will have easier credit conditions by the end of the year, but they definitely have a lower cost of credit right now.
Maybe we could put up a 5-year chart for TLT, the big ETF that's a proxy for the U.S. bond market. In general, would you be a buyer of U.S. long-term bonds right now, Earl?
No, I'm not as positive on TLT because it's 20-year bonds is underlying, and I'm not as positive on 30-year bonds. I am positive 10-year bonds and 5-year bonds. So right now we have a slight underweight, but we're coming very close to levels where we start buying bonds. And the distinction is once you get out into that 30-year, 20-year factor, there's so many other things that could impact the level of those rates, which are inflation impacts everything, but most importantly, fiscal. What's your deficit spending and what's going on there? And also the increased geopolitical uncertainty brings a bid or buyers of your shorter term bonds, 5 to 10 years, because there's increased uncertainty in 20 to 30 years. So you want to get more yield there. So we're not a big buyer of TLT or a big positive TLT or 30-year bonds, but we are positive 10-year bonds and earlier maturities.
You have a bond suggestion for us, for those investors who like buying corporate bonds, and it's an issue by MDA Space.
Yeah, they're actually the makers of the Canada Arm. If you remember the Canada Arms from a year back and say, so they're the makers of the Canada Arm. And so they're in the defense, military defense area. They're an approved bidder for RFPs for U.S. Shield RFPs that go out there, and they're a big client of the Canadian government through Telestat. So we like their revenues, $1 billion a year. We like that they have a backlog, $4 billion plus backlog. Their interest coverage, so their ability to pay the interest on the bond's good, and their yield is exceptional. It's 6.4%, which is 150 basis points over your Canada bond. So we really like that. They are high yield. And the reason why they're high yield is it's a capital intensive business. And they have concentrated clients, the governments. And we know how it could go in the U.S. It's a bit more fickle than it would be in Canada. But the overall trend of higher defense spending, we think is very supportive. And that's a company we like very much.
Right. I see the S&P rating is BB minus, which would be investment grade.
Yeah, high yield, as they refer to it. It's not the lowest of high yield. High yield could go to CCC. Yeah. So it's right in the mid. It's basically the better high yield company, if I could say that. And it's a company we're very comfortable holding. One thing I would put out there from an individual investor perspective, you don't want to hold this alone. You want it in a portfolio of bonds because obviously there's always default risk, and you don't want one bond driving your overall return. So you want it in a broader portfolio of bonds, but it is an attractive bond in a portfolio.
Now, this may not be on your radar, but can you remind me, has BMO issued an ETF that tracks high yield bonds? Or I know our market is so much smaller domestically.
Yeah, you know what? I think BMO has one of the largest suites of ETFs, definitely here in Canada, fixed income ETFs. So we have everything from shorter corporates to longer high yield and everything in between, so to speak. Like our active core fixed income mandate is one of those ETFs, is at CPB. But yeah, very broad array of fixed income ETFs. So you could do whatever you'd like to do in ETFs, basically, through the BMOs.
Thank you very much. Yeah, that one. I think you refer. You have CBO as well, which is the Oh, sorry, that's an iShares product. But you guys, and you have the biggest. I think you have the single biggest bond fund in Canada, ZAG.
Yes, ZAG, which covers the FTSE universe.
Right.
So we have the passive, which is ZAG, and then the one I mentioned, ZCPB, is the active, based on the same underlying universe. So we go into high yield, we go into tips, a little bit of global bonds as well too.
Thank you very much, Earl. Really appreciate it.
You're welcome.
Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management. Coming up, the latest on U.S. lawmakers trying to step up to prevent Donald Trump from pulling off another Venezuela-type operation without congressional approval. U.S. senators are trying to block President Donald Trump from taking action against Venezuela again. This is after Trump told the New York Times that America could operate in Venezuela for several years. Of course, the White House is moving to advance Washington's domination in the Western Hemisphere. It could, though, lose influence in other regions to its biggest rival, China. CTV senior correspondent Judy Trinh has more in this report.
Right now, an armada of American warships is gathered off the coast of Venezuela. With some resources redirected from the Pacific, China may feel more emboldened to expand its sphere of influence.
If the Venezuela campaign spirals into something where the United States is kind of chasing its tail in the Western Hemisphere, that's all to the good from the point of view of Beijing.
Last month, Beijing conducted military drills to practice blockading Taiwan. Now, after the capture of Nicolas Maduro, the island could be more vulnerable.
If China were, for example, to do some kind of snatch and grab operation to pick up the president of Taiwan and bring him back to China, on what basis would the United States object to that?
Beijing says Trump's takeover of Venezuela is a violation of international law. Venezuela owes China $10 billion in oil debt, which is at risk. But analysts say China could gain international support at the expense of the U.S.
advance their strategic narrative, which basically positions the U.S. as undermining international law, particularly under President Trump, and basically contrasts that with, in the case of China, China saying that they uphold international law, that they want to be responsible major power. So this really plays into their diplomatic and political narrative.
Chinese President Xi Jinping and Trump are expected to meet at least 4 times this year, including a state visit by Trump to Beijing in April. Judy Trinh, CTV News, Ottawa.
The Argo Sasquatch, an amphibious made-in-Canada vehicle, is designed to operate in harsh environments. We're going to have more on that when we come back. Let's take a look now at the Argo Sasquatch. It's an amphibious made-in-Canada vehicle for harsh environments. It can swim, it can climb, and it can cut through snow and ice. And it could be the future when it comes to saving lives in a disaster. CTV's Omer Sashadina has more in this report.
It may just look like a souped-up tractor, but this is a kind of Canadian hero, a 5,000-pound hero that can revolutionize rescue efforts in Ontario. And it's the new love of Rahul Singh's life.
These are beasts, like they're extreme all-terrain vehicles.
Singh is the founder of Global Medic, a disaster relief charity based in Toronto. He is a recently retired paramedic who founded the group back in 1998. Since then, Global Medic has helped 6 million people in 90 countries with the help of 7,000 volunteers across Canada. And for the ones based in Ontario, at least, this tractor is going to make their work easier.
So what's behind you?
This one's called the Argo Sasquatch. This, to me, is the future. At Global Medic, we always want to innovate as part of our way of getting the right aid to the right people at the right time. That's the next-gen innovation for us.
The Sasquatch can swim, climb, and cut through snow and ice, invaluable features for a Canadian rescue machine.
We know with climate change, we get these significant weather events. So if people are trapped by snow and we got to get in and rescue them, sure, we can come in by snowmobile, right? We can pull drivers off the highway. But if grandma slips and breaks her hip, we can't pull her out on a snowmobile. Make sure you grab it and you're going to this side.
We go for a test drive with Rahul on a farm field about an hour north of Toronto.
Perfect. Awesome. You're in? All right.
Inside, a computer that controls key functions, like deflating tires for more traction on terrain that's especially challenging.
So now you want to go to trail. So you either push there or there.
So this will automatically adjust the tire pressure?
Yeah.
It's a feature we needed when we got into a tough spot.
There you go. And look at it. It's incredible.
Requiring a 180-degree turn.
It's almost like it's got legs, right? And it's just slowly going from one side to the other.
Don't you think you should be driving into that ditch?
Yeah.
The $250,000 dynamo is funded by the Ontario government, and you might be surprised to learn the Sasquatch is made right here in Canada.
This completed machine weighs just over 5,000 pounds.
The factory employs about 150 workers, but despite their product's capabilities, because of U.S. tariffs on raw materials, they've had to pass on higher costs to buyers and lay off about 5% of their workforce.
We've had a slight reduction in some of our labor. Everyone's happy to be here. We're making a good product. And so we know that it is serving the greater good out there in the marketplace, but still apprehension is on everyone's mind on what the future holds.
The company says they have something to look forward to. The head of sales says the rest of the world is noticing them.
Where have you been able to branch out and sort of make some inroads?
Europe, Australia, New Zealand, countries around the world, we're definitely seeing business pick up.
We've got one and I want more.
But if Rahul Singh has a say, the Sasquatch is a homegrown machine that should pique interest right here in Canada.
Whether it's the storms, whether it's the snow, the ice storm, or the flooding, we know more people will be in harm's way. We're going to be responding a lot more and helping people, and we're going to need better tools right here in Ontario. So we should be using the Ontario-made solution for right here in Ontario.
That thing looks like a lot of fun. Okay, let's see how the major Asian markets finished the day. There are worrying tensions between the Chinese and the Japanese. Now, China says that Japan is pondering acquiring nuclear weapons, even though Tokyo has for decades renounced any such plan. But there are increasing tensions between the two nations. Let's have a look now at European stocks. Interesting development there. The European Union countries are supporting a trade deal with the Mercosur bloc of countries in South America. And we could see the EU sign its biggest free trade agreement next week. But the French and Italians are concerned about the impact on food, and they have objected to this thing. It looks like part of their objection may be concerns about a flood of food imports from South America. Let's stick with our international focus here. The European Central Bank President, Christine Lagarde, has insisted she's not interested in returning to French politics and running in the presidential elections due in just 15 months. Lagarde spoke with Bloomberg's Francine Lacqua about Europe's fragility, rising populism, and how she stays calm during global shocks.
You're the woman that they call in a crisis.
Yes, I'm Mrs. Crisis.
You're Mrs. Crisis with a great sense of humor. Does that help?
Always, yes. In times of crisis, you can sort of go so deep and deep and deep, and you sort of dig the hole in which you are burying yourself. And the sense of humor and a good laugh can just put things in perspective.
Would you consider going back into politics?
No, I don't think so.
Why not? You said you wouldn't be suited to be French president.
You know, I've seen presidents come and go, and I've seen them age and change, and it's past my bedtime.
What will you do next? I mean, there's always rumors. Do you think about what you do next, or are you focused more in the here and now?
I'm here and now, but the truth of the matter is that I've always taken risk. I've never sort of secured my position to make sure that the pension was there and that the comfort was guaranteed and that I was on an unlimited term. No, it's sometimes you just have to jump.
Let's have a look at U.S. futures as we count down to the opening bells. And it looks as though we could get a higher open for U.S. stocks, which, of course, are trading near record highs. The S&P 500 closing yesterday, let me get that number for you, at 6,921. We could get an open today of 6,971, which would be a new record for the S&P 500, or at least would eclipse its previous record high close, which was on Tuesday. So we could get U.S. stocks opening in record territory this morning. Let's have a look at Vistra, which is a big U.S. electricity generator. And we saw those shares move up. VST is the symbol. We did see those shares move up in the pre-market. It has announced a deal with Meta to support nuclear plants. Whoa, look at the stock rallying 20% there. I see that this Vistra deal with Meta is being described as a mega nuclear transaction. Yet another endorsement there of nuclear power. Opening bells are next. Okay, at the NASDAQ, iHerb is doing the honors. It's a retailer of healthy food products. At the NYSE, it's the professional bull rider celebrating the PBR Monster Energy Buck Off. I'm thinking of taking up bull riding. It seems like a good hobby for an older man. At the TSX, 10X Protocol celebrating the company's new listing on the TSX Venture Exchange. It's time for the first 50. So let's have a look at how the North American bourses are opening right now. So we got a TSX at 32,526, and it's got to be close to a record. If it's not quite there, yep, sure enough, we're in new record territory for the TSX. And let's have a look at the S&P 500. You can in some ways say the world's favorite equity benchmark. That one, nope, still down a little bit from Tuesday's record high close, but certainly up and close to all-time highs. One stock, of course, we're watching, Aritzia beating expectations in the latest quarter. Another surge in same-store sales, and that stock keeps hitting record after record. A market darling, Aritzia, the clothing retailer. Yep, wow, look at that, $130, a new high. Let's get some movers south of the border from Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team. Jeff, thanks very much indeed for joining us. Meta going all in on nuclear power.
Yeah, and as a result, it is driving the stock prices higher of a number of independent power producers. Vistra is the top performing stock in the S&P 500 so far this morning. It is up like a rocket after this Meta deal. So the stock was up 17% in the pre-market session. It is one of these stocks that has been related to the kind of the AI play, the data center build out. And indeed, what we're seeing today here is a deal struck with Meta. Meta is going to use additional power from Vistra power centers, pardon me. Yeah, it's up 17% here in the regular trading session as well. Not only that, Meta is also striking a handful of deals with other power providers, including Oklo, which is a small nuclear reactor company backed by Sam Altman, as well as TerraPower, which is backed by Bill Gates. Oklo is publicly traded. That one is moving higher this morning. And a number of other movers within the kind of the nuclear power space in the United States. Constellation Energy, which was up there on the screen, moving higher this morning as well. So really, really kind of a bullish move this morning with a lot of power. This is 6 gigawatts of power, which would be enough to do 5 million homes. It's not doing homes, though. It's doing data centers. That's the plan.
5 million homes. General Motors taking big charges on electric vehicles.
Yes, General Motors announcing a bunch of additional charges this morning. Now, kind of sorting them out is a bit of a challenge. So it is taking $6 billion in new charges related to its electric vehicle business, and another $1.1 billion in charges related to the restructuring of its China business. Now, if you add up the total amount of charges that it has taken, General Motors has taken related to its electric vehicle business, now we get to $7.6 billion in total when you add in these ones today. So this is the worst performing stock in the S&P 500. So far today, down 2%. However, Wall Street, again, likes the move. They liked the move when Ford did it with a significantly larger number of charges related to their electric vehicle business. And they like it when General Motors is doing it so far this morning. So Mizuho Securities out this morning, raising the price target on General Motors to $100 from $90 a share. Generally, what we have seen when these car companies have come out and kind of ripped off the Band-Aid and taken these charges is kind of an expectation that the worst is behind them now and potentially a move forward. So that's what we're seeing from Wall Street analysts, even if we are seeing the stock down today.
Jeff, thanks very much indeed. Bloomberg's Jeff Morgan. Coming up, finding opportunities in stocks in 2026. Our guest says stock market valuations are high and discounts are hard to find. However, he argues that earnings growth is real despite the noise, and he's bullish on stocks for 2026. We're joined by Ryan Belanger, founder of Claro Advisors. Ryan, always great to see you. Thank you very much indeed for joining us.
Good morning.
Start off with the U.S. market. We do keep hearing that the valuation is full, but profit growth is a fundamental driver for stocks in historical terms, and you think that that's intact for now?
Yeah, I really do. I think we're in a new kind of era here with productivity gains kind of across the board. I mean, if you think of certainly most industries out there, people are getting significantly more productive. And as a result, that allows companies to run more efficiently and earn more profits. And it's not for every company, it's not for every industry, but most will see positive benefits from the development of the AI technology. And we think that's going to continue to push profits up in the future.
But you note that some jobs will go.
Oh, definitely. Yeah. I mean, it's change, and if you think about over the last few decades of innovation, jobs that were once, fairly regular jobs are now automated. But those people found new jobs and they learned new skills. and they learned how to work with the new technology that needs maintenance and upgrades. And I think that's just kind of how these cycles go. So I think workers should be able to find jobs. I know it's a little bit of a soft environment at the moment, but for the people that are reinvesting in new skills and learning new ways to use this technology, then I think there are going to be plenty of jobs for everybody.
You say one headwind could be midterm elections in the United States this year, and often midterm election years are choppy.
I think so. That's just historically, and there's just a lot of political infighting, and it's confusing to see the vision, and people are distracted. They're running for campaigns. They're not out there, trying to make positive change in their communities. So I think it's just the natural distraction of that. Those elections tend to take people's eye off the ball a little bit.
And you just turning to the Fed, even though people aren't expecting a cut this month, there have been reductions. And you say, and I think we've heard this from other analysts, that typically when the Fed cuts and it's not a recession, the market tends to do well.
Yeah. I mean, this is something we've been saying for a long time. We call it a non-recessionary rate cut. So far, we haven't seen a recession, so that is well defined. And that's typically followed by a double-digit market move the next year. Overall, just generally positive. And just speaking of numbers and trends, if you start the year out with 5 trading days up, 5 of the last 6 years that has happened, and we've had positive markets. And then just a little bit more broadly speaking, the month of January, if that's positive, you get about a 68% chance that the year is going to be positive. And so if you're into those types of longer term trends, the start to the year that we've had would vision a nice positive year for investors. And so we're certainly hoping that's the case.
We have Canadian stocks hitting a record high today. Are you seeing opportunities in this country?
Yeah, I think so. I mean, one stock we've looked at, and I think we've talked about it in the past, is TD Bank. That stock has moved up quite a bit. It's kind of a sleepy stock for a long time, but I'm sure many Canadians are owning that. And there's just so much change going on with, certainly politically on how the countries are kind of interacting here. But, there's a lot of news in the energy space and mining. And so I think as investors, you just want to be broadly diversified. I mean, what we tell our investors is you just got to own a little bit of everything. Because look at this year, for example, small cap stocks are outperforming the large caps. And that's been an inverse of what's happened historically the last number of years. So, and actually mid caps as well are outperforming the large cap peers. So that's a change. And so any investors who dumped those exposures would be kicking themselves. And so we typically keep a broad asset allocation overall.
Yeah, TD stock hit a record this week. Would you be inclined to buy it with new money, TD Bank?
I don't, we tend to stay away from single stocks. We are, more using ETFs and funds to manage things. But if a client had a particular interest to own a stock, I think it's a relatively, safe bet, banks in general. So I think you'd be fine owning that stock.
Just finally, we've got a lot of turmoil linked to U.S. President Donald Trump threatening to take over Greenland, kidnapping or detaining the Venezuelan leader. Do you think that's a threat to the market?
Always. I think these are just distractions. Geopolitical risks is the bucket we would put these under, and history is littered with them. And if you zoomed out of a long-term S&P 500 chart, you'd see hundreds of these things that have gone on, and yet, because of the ingenuity of the American consumer and just global capitalism in general, you get equity investors get rewarded for owning shares over the long term. And so if there is any opportunity by a geopolitical disruptive event, meaning stocks going down, we always urge investors to if they've got the time horizon and the risk tolerance, to try to take advantage of those opportunities of weakness.
Ryan, thanks very much indeed.
Thank you.
Ryan Bellagé, founder of Claro Advisors. Coming up, we are going to drill into that U.S. labor data. Does it point to any underlying weakness? in the U.S. economy. Hiring did slow in December. We saw slower hiring in the United States in December. Employers added an estimated 50,000 jobs. How is this going to affect the interest rate decision by the Fed this month? We're joined by Gennady Goldberg, head of U.S. rate strategy at TD Securities. Gennady, great to see you. Thanks very much. Tell us what jumped out for you with this U.S. labor report.
Yeah, and thanks for having me. Definitely a noisy one, I would say. You did get a below consensus payroll report. What really jumped out was the lower unemployment rate. Now, some of that is unwinding some of this noise in the wake of the government shutdown. Certainly, you had lots and lots of noise in the data. What we're really seeing is a somewhat softer labor market, still very consistent with low hire, low fire. I think the good summary statistics are the 3 and 6 month moving averages are somewhere between 30 and 40,000 for private sector employment, and that's really kind of the steady state effectively. What we're going to be watching in the next couple of months is whether that unemployment rate really continues to drift higher, or if 4.6% was the high we've seen for now.
And the Fed, obviously, the labor market, infamously a lagging indicator, or traditionally seen as that. What message do you think the Fed will take from the latest few months in employment?
I think they're still recovering from, a lack of data as well. To some extent, I think you're going to see a message of data dependence. They're still waiting and watching a lot of that economic data. They are going to be leaning a little bit less heavily on their worries about inflation. I think inflation now is a little bit more under control than it's been in the last kind of 6 to 12 months, or at least on an outlook perspective. Really what we're looking at is, what happens to the U.S. economy next? Is the U.S. economy moderating? Is the labor market moderating? All of those things are really things that the Fed is going to try to ascertain over the next couple of months. If that unemployment rate stays steady, they could potentially pause for longer. Our view is still that they actually deliver a rate cut in March. We don't think a rate cut in January is likely. The market's effectively priced it out fully. The market's only pricing in about 7 or 8 basis points of cuts at the March meeting. But every data point matters. Every data point really matters to the Fed, and we're going to have data dependent activity for the foreseeable future.
RBC came out with an incredible report this week. We're trying to get them on, that said consumption by 10% of U.S. households was behind, or lately has been behind, 1/3 of all economic activity in the United States. The gap in income and wealth has become so great. I guess that's tough for the Fed, isn't it? Because you've got one group that are struggling, a huge portion of the population not doing that well.
Yeah, and that's kind of the fears about this K-shaped economy, right? You've got folks on the upper end of the income spectrum actually doing relatively well, folks on the lower end of the income spectrum not doing that great, and that you've got that divergence. Now, there are expectations that the folks on the lower end of the spectrum will get supported by additional tax rebates because of the One Big Beautiful Bill Act. What really matters for the FOMC, though, is what's happening to the higher echelons. The democratizing factor in all of this is why they're so focused on the labor market, is the employment picture. If the employment picture really starts to soften, whether folks are at the higher end of the income spectrum or the lower end, that really starts to affect everyone. As long as the unemployment rate is relatively steady, they don't really necessarily have to move rates materially lower, but they're aware that at 3.75%, they're still tight on a relative basis, relative to neutral, closer to 3%. So they are going to be looking to take rates a bit lower.
I guess there's only so much you can do with monetary policy when it comes to income inequality. Apparently, in the second quarter of last year, consumers in the top 10% in America accounted for just under half of all U.S. household spending. And that was up from just over 1/3 in the early 90s. So it sounds like a very unbalanced economy.
I'd question those numbers a little bit. What we've seen is the top 20% accounting for about 40% of the spend. Certainly depends on how exactly you derive the calculations.
Yeah.
I've seen some more extreme estimates, but it does certainly seem as though income inequality is quite significant. What really matters, though, is really who's driving economic growth. And if you are seeing issues at the lower end of the income spectrum, is that something that the Fed should address, or is that more for policymakers? I would argue that's less for monetary policy, more for Congress.
Yeah, monetary policy, kind of a blunt tool in many ways. Yeah. Gennady, thank you very much indeed. Really appreciate it.
Thanks for having me.
Gennady Goldberg, head of U.S. rate strategy at TD Securities. The U.S. Supreme Court is expected to rule on whether U.S. President Donald Trump's International Emergency Economic Powers Act tariffs against Canada and other nations are even legal. Let's get more from Jeremy Sharon of CTV News. Jeremy, thanks very much. Just remind us what the U.S. Supreme Court is ruling on here, please.
Yeah, Andy, as you've touched on, these are the IEEPA tariffs, so-called IEEPA tariffs. For Canada's purposes, we can call them the fentanyl tariffs. These were imposed early on in the trade war. 35% is the tariff rate right now on products not covered by CUSMA. Of course, most of what Canada trades with the U.S. is covered by the free trade agreement, but anything that is not is subject to 35% tariff under IEEPA. And 10% on energy products. So not massively widespread in terms of impact on our economy. Nonetheless, this does have some kind of impact, and today's ruling is an important one. Now, the other important thing to point out, it is not definitive that we're getting a ruling on this today. We just know the Supreme Court has scheduled today as an opinion day. It means it's the first opportunity for a ruling on the IEEPA tariffs case. But as is procedure with the Supreme Court, we don't know what cases they're ruling on today. We should find out around 10 o'clock. That's when the rulings are expected. It is widely believed that the ruling will be on the IEEPA tariffs case, but we don't know definitively. But, Andy, this will have a massive impact on, more than likely, how the U.S. administration moves forward with its tariffs policies, because the big challenge after this is going to be recouping some of that money. It's expected, or it's estimated, about $150 billion in revenue has been collected through IEEPA tariffs by the U.S. government. A lot of money in terms of impact here, but recouping that money, getting the refunds, is going to be a massive challenge. I think the greater impact most experts have pointed to is likely to be the behavior of the U.S. administration towards tariffs, because this is going to be a signal by the U.S. Supreme Court as to whether or not the U.S. president is abusing his powers in some respects.
Right. I was actually looking at one Canadian jeweler's website, a local one, and they said, yeah, sorry, U.S. customers, we're just not sending you stuff anymore for now because of duties. I'm not sure if it was de minimis or tariffs, but certainly it is. All this is affecting Canadian firms.
Absolutely. And, to your point, while today's decision only affects a specific category of tariffs, again, it is going to be very telling on the validity of the tariffs across the board and confidence for businesses moving forward as to whether or not the U.S. administration is going to continue down this path. It has signaled that it is going to do so. U.S. Trade Representative Jamieson Greer has said that even if the Supreme Court rules against the IEEPA tariffs, that the administration is confident that they could recuperate those revenues through different tariffs imposed under different legal authorities. So, the administration seems pretty hard set on a trade policy moving forward, or a tariff policy rather moving forward. But there's no question that in terms of business confidence moving forward, there will be an impact here based on the decision.
Thank you very much, Jeremy.
Anytime.
Okay, that was our colleague Jeremy Sharon. Up next, we're going to hear why investors, after the big run-up in stocks, are eyeing valuations. After that big run-up in stocks, valuations are top of mind for many investors. We are joined by BNN Bloomberg contributor John Ehrlichman. John hosts the Ticker Take channel on YouTube. John, talk to us about this valuations theme, and thanks for joining us.
Good to see you, Andy. This seems like it's going to be one of the biggest themes of 2026. Growth stocks obviously have had this big run, and there are some that still have momentum in these early days. You've been talking about them all week, like some of these memory chip makers, storage players that are feeding into the AI shortages. But can you believe in these valuations longer term? So we've been hearing from a lot of investors who are kind of framing themselves as growth/value investors. In other words, they still want the growth. They just want companies that have predictable businesses and maybe were underrepresented in this run-up that we've seen so far. I know you were talking to Grant White of Endeavor this week. I mean, we talked to him on Ticker Tag, and he sort of put forward this profile of an investor who is seeking value through a growth lens. That seems like that's going to be one of the dominant themes this year.
Let's go through some stocks that are on the radar here. It's Thriv, I believe that's how it's pronounced. THRV is the symbol. What's happening with that one? Or what is that company, John?
It's interesting. It's sort of a hybrid, which is maybe why it kind of falls into, at least according to Grant White of Endeavor, the growth versus value camp, because they have some, for lack of a better word, legacy parts of the business, like yellowpages.com, which, isn't necessarily the same destination it once was, but they take the cash flow from that and they put it to work in software offerings that they think can help businesses. And so there is some predictability to the business from that. And as you can see from the stock price, some weakness, call it in the last year, unlike a lot of other stocks.
John, we'll have to leave it there. Sorry, we just ran out of time. I really appreciate it. John Ehrlichman, host of the Ticker Take channel on YouTube. Up next, lots more on the Open. Welcome to the second hour of the Open. Let's get to the big stories we're bringing you from our newsroom. Data from StatsCan indicates that the Canadian labour force, or rather the labour market, added more jobs than expected last month. The economy created 8,200 jobs in December. Economists were expecting a loss of 2,500 positions. The job gains were led by increases in Ontario and Quebec, mostly in healthcare. And the unemployment rate, meanwhile, rose to 6.8%. We spoke to an economist who says the latest data is not enough to sway expectations for the Bank of Canada.
We think it's still on hold. We think it's on hold for the remainder of the year, unless something very disruptive were to happen. Of course, we're going to be looking at the CUSMA revision talks very attentively. I think that is the major wild card right now. But otherwise, with the information at hand, I don't think there's a compelling case to do anything at the next meeting.
Shares in Aritzia surging to a new record high after the clothing retailer posted higher profit in its latest quarter and revenue that topped expectations. In fact, revenue jumped more than 40% year over year, and the company raised its full-year forecast. Same-store sales increased across all categories. Aritzia says the results were driven by higher U.S. sales, digital initiatives, and marketing. Shares in Tilray up about 1%. Net revenue and profit in the latest quarter beat estimates, with distribution sales 26% up from last year. Tilray's cannabis business also saw an increase boosted by higher sales in its Canadian and international segments. And the company says it expects to see growth in its medical cannabis unit following U.S. President Donald Trump's move to encourage reclassification of the drug. There's a look at the TSX trading in record territory this morning. After a strong 2025, shares have been climbing again this year, so we're at a new all-time record high level for the TSX. Let me just confirm that. Sure enough, so far this year, 2026 is but a pup so far, but our market is up almost 3%. Now let's have a look at the U.S. markets. The S&P 500 higher, not far short of 7,000, as you can see. However, it's still slightly, only 2 points down from Tuesday's record high close. And finally, let's have a look at oil, see how it's doing. Oil up almost 2.5% here, which is interesting. Iranian protests escalating. Can't believe the courage of the people who show up on the streets there. You wouldn't catch me doing that. I wouldn't be brave enough. But certainly, it's raised questions about instability in Iran and possibly a risk to supply. Okay, so there's a lot of money still going into AI. U.S. venture capital firm Andreessen Horowitz, a legend in Silicon Valley, just got attention after raising more than $15 billion U.S. with plans to invest in AI, defense, and biotech. And closer to home, Canadian firm Onyx is extending the life cycle of the public markets. What does that mean? Let's get more from Dan Rahinton, portfolio manager at IA Global Asset Management. Dan, thanks very much indeed.
Yeah, thanks for having me.
Tell us what we should bear in mind about Onyx here.
Yeah, and I want to bring in what you talked about with Andreessen Horowitz as well, because it's part of a broader continuum and a story that doesn't get as much attention as it should, which is the role that private markets play today in capital formation is so much more significant than it has been in almost a generation's time. Mm-hmm. Onyx is one part of that conversation because what they did with the continuation fund, Onyx's fundraising story is actually more a question of curtailing, retrenching back to their industrial roots. But what I thought was really interesting about the continuation fund, the $1.6 billion, is there's a few assets they want to hold on to, but private equity windows are very clear cut, 7 years with 3 years before that to deploy. So if you want to hold on to an asset for a decade, the normal route, Andy, was take it public.
Right.
And now the route that's being normalized is, well, we'll just hang on to it longer because we like it that much more. And then you make a few phone calls to some big institutional partners of yours, and then you can hold on to it for the foreseeable future. And I'll bring in Andreessen Horowitz into that conversation as well, because their big fundraise, what I think is interesting about that is half of that was actually to put it into late stage companies. So this isn't the company you think of as early seed, or Series A, Series B, when the founders are just figuring out their way. These are large assets, like Anduril is one of the largest military manufacturers in the U.S. at this point.
They make submarine drones, I believe.
That's what they're looking to do. They're trying to do ballistic missiles. Cruise missiles, I apologize. And then you have Cursor, which is another $30 billion asset. Then there's Databricks, which is a $100 billion plus asset. These are mid to large cap public companies that are in a venture capitalist hand still, and mid to large cap mid cap companies in the case of Onyx that are in continuation funds. And I think that's a story that deserves more attention.
So when you say extending the life cycle, normally there was that traditional cycle, venture capital or private equity would buy a firm and then hope to make a huge profit when they took it public a few years down the road, but they're waiting much longer.
Yeah, and the path exactly was venture capital would say, we'll give you $1 million, $10 million, maybe 100 million, and then you got to go to the public markets.
To the old IPO, yeah.
And private equity would say, we'll take you out of the public markets, we'll do some stuff, 10 years later, go back to the public markets, and out we go. Now we're blurring all of those lines, and I think that's going to be interesting because there's already such a backlog of private companies that are waiting to go public that I think this is the year where either the big foundation model companies, the Anthropics, the OpenAIs of the world, do they go public or not? Or do they decide to go the Databricks route?
Go the what route?
The Databricks route, where you just go from Series A to your Series L. You just keep raising private rounds and keep floating that equity between the Andreessen Horowitz, the SoftBanks of the world. But this is the market where this is the year where we're going to see if public markets have a role to play in early mid-stage companies, or if it's only really going to be the mid to truly large cap stocks that stay public.
So I suppose if you go public and then the market is so fickle and your stock price tanks, That's sort of a black mark. It damages your reputation.
Exactly, and that's part of the interesting dynamic. I would tell you that there's truth. More sunlight is good for valuation. So having a stock that trades every day, being held accountable to a broad list of investors, professional investors like myself, retail investors that are doing it day to day by themselves. That whole continuum is a cleansing exercise. I'll use the words of the Zendesk CEO when he talked about going public, and this was many years ago, is eventually you got to move out of your parents' basement. So I think of public markets as that moment for going and really putting your fundamentals to the market test by a broad list of investors versus the 12 people that you call who are funding you in the private markets.
We have seen this steady decline in listed companies. I mean, and just regularly companies being taken private off the TSX.
Yeah, and I think one thing that's interesting to talk about here is the Canadian Venture Exchange is very unique. Like, we think of it as there's a venture market, then there's the primary listing market and the Toronto Stock Exchange. The venture market really doesn't exist elsewhere. So it's very unique territory, the way Canadian market structure is set up. But your broad point, Andy, is 100% correct. Outside of really capital-intensive companies, like resource companies, mining companies, and big industrial companies like that, we haven't seen public markets keep their market share, if you will.
And of course, one reason apparently is this is going back to the Paleolithic era. Your stockbroker would phone you up and tell you, hey, I got a good stock for you. But now he or she just sells you a money management program.
That's right. Yep. The consolidation on that front as well. And that's part of the broader soup. But I think the main point here is we're seeing this gray zone happen in a way that we haven't seen in, frankly, a generation. And
what do you mean a gray zone? Sorry.
The gray zone of what public markets are, what private markets are. There's now crossover funds. There's continuation funds like that's being talked about here with Onyx. But every one of these companies is doing so. And it's to an extent where even if you take a step back and you ask, Apollo is actually building an investment banking operation. So it's this type of dynamic that we're seeing where the nature of what it means to be public-private is fundamentally graying. And what will be interesting to see over time is, can individual founders push you further in that direction? And are they just motivated to stay private? Or do they see the value of public markets? And that's on the exchanges that we see to really drive that bus home.
Talk to us a bit more about Andreessen Horowitz, the legendary US firm. And you say national interests are increasingly on the agenda for a firm like that?
Yeah, and this is one of those things where the two founders would actually tell you they used to have security clearances with the US government. So they were privy to very secret information in the first place. So there was a time where venture capital was actually funding national strategic interest companies decades ago. Then there was a wave of basically in the last 25 years, the late 90s on till the last 2 years, there was a wave saying, we don't want anything to do with the government. We are in our own internet bubble, and whatever happens in the national interest, that's someone else's problem. It's back to the future all over again in 2026. We're going back to the world where venture capital raising, strategic industries is fully coming back into the fold at the very earliest stages. And it's not a surprise that Andreessen Horowitz is leading their charge because they are by far the biggest venture capital operation out there.
Dan, thank you very much indeed.
Thank you, Eddie.
Dan Rahinton, Portfolio Manager at IA Global Asset Management. Coming up, shares in Aritzia hitting a record high. We'll hear from an analyst after this. Shares in Aritzia hitting a record high today. Yet again, the company beat expectations. We are joined by Martin Landry, Managing Director, Equity Research in Consumer Products and Merchandising at Stifel. Martin, great to see you. Thank you very much indeed. So you note that this is the 10th consecutive earnings beat by Aritzia. Is there anything not to like here?
Indeed, Aritzia is hitting it on all cylinders. Look, the company is having a lot of success right now. Its products are getting a ton of traction. The results were very impressive. I mean, the same-store sales were up 34% year over year. That's one of the highest figures I've ever seen in my career. EPS came in at $1.10, up 54% year over year. So meaningfully ahead of consensus at 89 cents. So no wonder why the shares are reacting well today to these exceptional results.
We're looking at a market cap north of $14 billion right now. I mean, presumably the law of large numbers will catch up on them. They can't maintain this kind of growth forever.
That's sure. I mean, I'm not going to be sitting here saying that this is going to last forever. But one thing that propelled their sales this quarter was the launch of their mobile app.
Right.
Believe it or not, it's the first time that the company has launched a mobile app, and it was a very successful launch. They had 1.4 million downloads in the last 2 months. The app was launched in late October, and this allows them to boost their e-commerce sales. Their e-commerce sales were up really strong, and it allows them to cater also the offering on the phone to the person that's shopping, and provide a better experience, and probably provide a more customization of the offering.
It's interesting. So they had an e-commerce presence before, but just the fact that people can order clothes over their phones, or at least look at products, made that much of a difference?
Well, Andrew, I don't have to tell you that everybody is on their phone, and apps are very popular these days, right?
Yeah.
So you would have thought that Aritzia would have had an app a long time ago, like most retailers. But look, we saw this as upside, and we're seeing it in the numbers today. I mean, even look at their Canadian sales. Their Canadian sales were up 29% year over year, and Canada is a mature market for Aritzia. The number of stores were the same on a year-over-year basis, maybe a couple of expansions, but to have sales up 29% in Canada, it's pretty impressive, and it shows that the company's gaining significant share.
And you say they have fewer than 80 stores so far in the U.S., and you reckon there's plenty of room to grow?
Yeah, well, we see Aritzia as one of the best long-term compounder in our coverage universe, because they have a ton of reinvestment opportunities, like you mentioned. In the U.S., 72 stores. The company's talking about the potential to triple that number to 200. So tons of reinvestment opportunities, and with our return on invested capital north of 20%. Cash is going to compound really rapidly, and that's what we like to see, and that's what creates shareholder value.
And you say they're doing online sales abroad, but they haven't, outside the US and Canada, they haven't opened any brick and mortar yet?
Yeah, and that's another upside, another long-term potential that we see. The company alluded to it a little bit in the earnings call yesterday that, they have an international website, but no stores. And, they're talking about countries like the UK, like Australia, Germany, Switzerland, and Asia, and China in particular. So you got to think that in the next 5 years, we're going to see Aritzia with an international presence and boots on the ground internationally.
And just remind us, what is their target market? Is it from young to older women?
Well, that's when you step back and you're like, why is Aritzia having so much success? There's a couple of things that we can point to. First, the quality of their products, right? They're known for high quality, luxurious fabric. Their shopping experience, their stores are beautiful. They have cafes in some of their stores. And then the quality, when shoppers buy an Aritzia product, they know it's going to last. So they found a niche in the everyday luxury, where customers are splurging a little bit because they're not cheap, those products, but they feel that this thing's going to last for a couple of years. It's classic. It's, for your work day, for your outings with your friends on weekends, and for lounging at home. And it's from, 17 years old to 47 years old. So it's a broad market and a broad occasions for that. And that's what created their success.
They just, they're late last year, they opened in Manhattan's Flatiron district. It sounds pretty fancy, a 25,000 square foot flagship and soaring scallop ceilings. I guess you do want to have fancy stores in New York. That's a prestige thing.
Yes, it's a marketing tool. I would agree. And they've said that, their stores, their flagship stores, they've got 4 flagship stores, are like a really good marketing tool for them. It's also a great way to acquire new customers. These openings have been very successful for Aritzia. And last year they had a couple of them. So we're lapping these openings last year and seeing some really strong sales.
I guess we have to remember Lululemon, though. You remember, a few years ago, Lulu was posting sales growth like this. Rivals emerged. That stock has suffered lately.
Yeah, look, I don't cover Lulu, so it's a little harder for me to comment on Lulu, but I would agree that the fashion comes in cycle, and investors need to keep that in mind. But what we like about Aritzia is that it's classic offering, right? Very classical styles. And when you look at the company's balance sheet now, their cash balance has gone up to $650 million. It's, they have a lot of flexibility. They have a lot of room to redeploy capital and to give capital back to shareholders. So they're in a really, really good spot now. How long it lasts, we'll see. But like we said, we see it as a great long-term compounder in Canada.
Martin, thank you very much indeed. Really appreciate it. Martin Landry, a Managing Director in Equity Research, Consumer Products and Merchandising at Stifel. Coming up, today's ETF report and why a small, much-hyped IPO on SpaceX could put the spotlight on a small SPAC ETF. We're going to be right back. Let's get to today's ETF report. Fascinating story from Bloomberg's Eric Balchunas, an analyst at Bloomberg Intelligence. So SpaceX, people are speculating there'll be a monster IPO for Elon Musk's space company this year. The logical ticker symbol seems to be SPCX. There's only one problem. That symbol right now belongs to a tiny SPAC ETF that was issued by Tuttle Capital. SPACs, of course, are just capital shells that people float and later buy a company. Let's get more from Eric. Eric, that's really appreciate your joining us. Oh, he's not here right now. Sorry, but we'll just look at this ourselves. So the problem here for Musk is that once a company owns a symbol, you got to pay for it, or you got to do some kind of a deal. Now, Tuttle has seen a big drop in its SPAC ETF, and that part of the market has gone cool lately. So this could be opportunistic. Just sell it to Elon Musk and pocket a whole bunch of cash. The Tuttle fund right now, the SPAC fund, has under $10 million US in assets. And there is precedent here. An outfit called Roundhill was in a similar position with the ticker Meta. And Zuckerberg of Meta ended up buying it. We don't know exactly what was paid back here. But back in 2022, when Facebook rebranded as Meta, it approached Roundhill. And reports suggested at the time it was a handsome sum. So, of course, one suggestion here from Eric Balchunas of Bloomberg is that SpaceX could go down another route, perhaps Mars, M-A-R-S, but SPCX seems like the logical thing. Up next, we're going to drill into those Canadian job numbers once again. West Fraser Timber will take a write-down associated with its U.S. lumber operations. The Vancouver-based company says it will record an impairment of $400 million in its fourth quarter. West Fraser cited persistently challenging economic conditions that have impacted pricing as well as demand. Glencore has confirmed it's in talks that could see the company taken over by Rio Tinto. This comes a little over a year after earlier negotiations between the two collapsed. The mining giant says both companies have been discussing a potential combination of some or all of their businesses, including an all-share takeover. Bloomberg is also reporting that Rio is open to retaining Glencore's coal business if talks are successful. Glencore says Rio must announce its intention to make an offer by February 5th. Shares in WD-40 down about 8% after the maker of lubricant spray posted disappointing profit in its first quarter. Analysts are pointing to a 1% increase in sales compared to the same period last year. Not much of a gain. WD says the quarter was hurt by lower sales across the Asia-Pacific region due to timing factors in distribution. Toronto stocks hitting a record high today. You can see we're not far short of 32,600. Let's have a look at the S&P. You can see it's north of 6,952. Not far off record high levels, or even at them. Let me just confirm that. Nope, still down. No, I'm sorry. Yes, we are at a new record high for U.S. stocks. 6,944 was the close on Tuesday. So the S&P 500 now about 10 points higher than that. So a record high for U.S. stocks. We just got Canadian employment numbers. Unemployment rose in December to 6.8%. Now, the country did add just over 8,000 jobs last month. That did beat estimates. We're joined by Benjamin Rietzes, Managing Director and Canadian Rates and Macro Strategist at BMO. Thanks very much indeed for joining us, Benjamin.
Thanks for having me.
So the labour market holding in despite all the worries over tariff impacts, CUSMA, and companies apparently not investing much right now.
Well, I mean, hanging in there is probably the right way to look at it. What we've seen in the job numbers for the past number of months is a ton of volatility, material weakness in the summer, a big rebound in the fall, and the December report strikes us as a little more consistent with what's going on in the broader economy. We're seeing broader economic growth, definitely on the softer side, and the job numbers we had been getting in September, October, November, those were seemingly a little bit too strong to be consistent with the numbers. And today's number, small gain, increasing the unemployment rate, not all that surprising at the end of the day, and consistent with a Canadian economy that is still struggling under the weight of tariffs and uncertainty.
We have a population that's aging, like every country in the world just about, and we have cut back on immigration. So are demographics affecting the labour market right now?
Well, they do always. That will be more of a longer-term issue for Canada and for most other countries. As the population ages, you'll likely see the participation rate slowly tick down. Elderly tend to participate less in the labor force. That'll probably also pull down the unemployment rate over time. This is not a month-to-month thing. This is something you want to look at over a longer period of time. And there are some trends that will be present there, but not worth highlighting on a month-to-month basis.
The big cutback on temporary workers, so foreign workers or temporary Canadian residents, that must be having an effect as well.
Yes, and that'll likely continue to have an impact. I mean, one of the highlights of this report is that all of the gains were in full-time jobs. And part-time went down. There was also a big increase in the labor force, which is far larger than the population growth. That is an interesting quirk in the numbers. You tend to see a lot of volatility there. Again, you kind of want to look more at the trends here rather than the month-to-month moves. And the reasonable expectation to say that as population growth slows, you're expected to see labor force growth slow as well.
That's it. Of course, when you economists say labor force, you mean people who are working or available to work.
Correct. People who want to work or are working.
Right. Yeah. Generally, economists like to see an increase in the so-called participation rate, or they think it's a good sign for growth and wealth.
Well, it's healthy when more people want to work. It can add to growth. You get more people working, and creates more production, creates more income in the economy, and that can be additive to growth. There are, of course, limits to that, but we do try to encourage participation generally from a policy perspective, and the government does put in place a number of policies to push in that direction. You still get a decent amount of volatility there, and there are trends. Demographics play a pretty big role there over time as well.
Can you give us some perspective on wages? Have we been seeing consistent wage growth, Benjamin?
It has been trending lower. We're still at about 3.5%, give or take, which is more or less the average for the year. That is down from the past couple of years, but is at a decent rate. I mean, the hope is, I think, that some of the projects that are underway that the federal government is trying to push, help boost Canadian productivity, and that in turn helps push wage growth higher. What we want to see is those two coming in sync, and higher productivity pushing more wage growth, which drives higher earnings and income for everybody.
The current unemployment rate, 6.8%, is that high historically speaking?
It's not high historically speaking, but it is on the higher side of things from what we've seen for the past decade plus, where unemployment has been lower pretty consistently. And I mean, at this point, it's consistent with a modest output gap in Canada. I think the Bank of Canada will reiterate that in their monetary policy report later this month. And in the last report, it was around 1%, a little less than that at the midpoint. And they're still slack in the economy. I think that's really the key. And at this point, it's challenging to say when that's going to be taken up. There is still a ton of uncertainty out there. We don't know which way the USMCA is going to go. Negotiations are supposedly starting later this month. That's challenging for Canadian businesses. They don't necessarily want to be expanding their labor force at a moment when you don't really know what's coming on the horizon. And so you're seeing a sluggishness in investment, a sluggishness in hiring, and that's creating a challenging environment for job seekers generally and employment.
And finally, it's early days. It's largely anecdotal, I know, at this stage, but is AI having any discernible effect on the labor market?
It's really challenging to tease that out. There are some signs that maybe you're seeing a little bit of that, but personally, I would point more to the uncertainty on the business side rather than AI itself. You would see the impact likely more on new entrants than elsewhere. You can try and categorize things and as to sectors that would be more or less impacted by AI. But I think that's more of a long-term story over the next number of years, something definitely to keep an eye on. But as the economy turns, assuming we get a positive or at least not a negative outcome on USMCA, you'll see business sentiment turn. Hiring will likely pick up on the back of that. And you'll see some of those demographics that are struggling right now, the 15 to 24-year-olds, for example, hiring there will pick up. And so AI over time has an impact, but I wouldn't stress that too much at this point.
Benjamin, thank you very much indeed.
Thank you.
Benjamin Rees is Managing Director and Canadian Rates and Macro Strategist at BMO. Coming up, Hot Picks, we'll check out 3 plays in semiconductors. There are concerns about the future of Greenland after the White House again suggested the U.S. could buy the island or invade it. We heard from Bob Rae, Canada's former ambassador to the UN, to discuss the possibility of a U.S. invasion.
They've been very explicit about the plan, which is to essentially take over Greenland. The president has said it many times. Stephen Miller has said it. Vice President has been involved. A lot of people in the administration are talking about it. So I don't think we can say it's an exaggeration. I think it's clearly an important part of the American plan to control as much of the Western Hemisphere as they possibly can.
Okay, so you do see it as a plan as opposed to just a musing of the president?
Totally.
Okay.
Yeah, absolutely.
Is this about Arctic sovereignty, as we hear Donald Trump talk about security needed in the Arctic? Is this about critical minerals or Trump's disregard for NATO or something else?
I think it's all of the above. I don't think, based on what we've seen and what they've done in Venezuela, the way in which they've structured whatever agreements have been made for Gaza, and what they've been discussing with Ukraine, what they've also discussed with Rwanda and the Congo with respect to that treaty. Everything they do has what I would call an economic, with a polite way to say would be an economic component. Another word would be to say it's a grift component, because it really has to do directly with the interests of the United States, but also with the interests of investors and people who are close to the president. So this is the new Trump formula. Something for me, something for you, something for others, but there's always something for me. That's the way it seems to work, which is what makes it, frankly, so absolutely appalling. When King Leopold's Ghost, a great book written many years ago, described how the Belgian king in the 19th century basically looted the Congo, completely looted it, as well as killing millions of people. But we're seeing a pattern, which is gunboat diplomacy, people going up the river, creating a crisis, and then stealing the resources. And that seems to be the common thread through the whole piece.
Do you see this then as a clear abuse of American power and authority?
Absolutely. I think the American people see it many American people see it that way. They should see it that way. There's nothing wholesome about this whole enterprise. It is not about, quote, security. If there was a security concern, it could be dealt with through NATO. NATO could deal with that. There's no need to punish the entire population of Greenland to create security. There's no need to take over a country. There's no need to run a country, to run an oil industry. Those things have nothing to do with security. They have everything to do with taking advantage of a situation and using power to exclude the people of a country and to take advantage of their vulnerability and to use that wealth for their own advantage. I mean, this is not a pretty picture by any stretch of the imagination.
You have said in the past that Trump only understands power. So how does Europe, Canada, or anyone else get him to respect world order?
I think there's two elements to this. The first is what the rest of the world can do together, and the way in which we can begin to work more effectively together to counter the arguments that the president is making, and to show the people of Greenland and show everyone what the alternatives are. The second has to do with Congress and with all the elements of American democracy. A government that is unhinged from international law is usually, I would say 99.9% of the time, unhinged from domestic law as well. And certainly there are voices in Congress who are expressing this point of view. And I think this is the nature of the debate that will happen inside the United States. And public opinion in the United States is not particularly thrilled with these ventures and these adventures and these advantages that President Trump and his associates are taking to their own personal benefit. And I think that's where this becomes a major issue for the American public.
Okay, what would the fallout of a U.S. incursion into Greenland look like? What would be the fallout as far as a reaction from Canada or other NATO allies?
Well, I think we're already seeing it. I mean, I don't think we know exactly how this is exactly going to unfold, except we do know that something is going to unfold, either a conscious decision not to proceed or a decision to say, here's the plan. And they're certainly not going to tell us about it or confide in their allies as to how it is they intend to do this. But whichever it is, it's going to be extremely problematic. It's going to be extremely damaging to the NATO alliance in every sense, and it will dramatically undermine the credibility of the United States from an international perspective. The reputation of the country is at stake. And as all of us know in our lives, our reputations are all we have. And this will create enormous reputational damage to the United States.
Has the world and world leaders or UN advocates been too diplomatic about this? And I ask because that is typically, historically, how conflicts get worked out at a high level. There is diplomacy. But do you feel like leaders in the world have been a little too diplomatic here and should have already taken some action?
Well, I don't think diplomacy should be synonymous with weakness. We need to be clear about what is wrong with this idea. It's an affront to sovereignty. It's an affront to territorial integrity. It's an affront to the Charter of the United Nations. It's with respect to the economic aspects of it, it is so obvious that it is an abuse of power. And I don't know why people are afraid to use these words. I don't know why all of us wouldn't be saying the same thing at the same time. I think the language that's being used that came out of Paris this last week has been better and stronger. But I think our position should be absolutely clear. And I think the sense of outrage that is shared by, according to all the polls, the majority of the American public, as well as the vast majority of world opinion, I think should be made very, very clear. Because I think the damage to the United States, and frankly, the damage to the security of the United States, the security of the United States depends, as all our security depends, on the confidence and the goodwill of the vast majority of people in the world. And they're losing that hand over fist with this kind of behavior.
It's interesting, Bob Ray, the former ambassador to the UN, mentioning that book, King Leopold's Ghosts, about Belgium's awful activities in the Congo to produce rubber. Coming up, hot picks in chips. Hot picks today, we're looking at semiconductors, and our guest has a company called Microchip Technology as a top pick. We're joined by Chris Danley, Managing Director, Semiconductor Lead Analyst at Citi. Chris, thank you very much indeed for joining us.
Thanks for having me, Andrew.
It's kind of a generic name, isn't it? Microchip Technology, the symbol MCHP. Can you remind us what is their role in the industry and what attracts you to them?
Sure. So I have a nickname for them. I just call them the Chipper. It's a little more, I guess, zippy than Microchip. So Microchip's primary product, about 2/3 of their business, is a microcontroller. And what a microcontroller is it's like a simplified microprocessor for common everyday applications. You don't need a $100 Intel or AMD chip in your coffee maker or your e-bike or your monitor. These things are ubiquitous. It's about a $50 billion market, so it's one of the bigger markets out there in semiconductors. And Microchip has the best microcontroller out there.
So these would be used in sort of lower tech products. We're not talking about AI, for example.
No. They have a little bit of exposure to AI, and in particular robotics, which was one of the big themes from CES, the trade show that I was at this year. But I would say that they're probably 40% of their business is the industrial market, 25% of their business is the automotive market. There's probably $100 to $150 of microcontroller content in, say, a high-end car. And then in terms of factory automation, there's tons of microcontrollers. Like an HVAC system. So whatever tells your temperature gauge to communicate back to the blower to heat it or cool it, or in a car where you have all these different sensors and a fuel gauge or a tire pressure monitor. All those things need a microcontroller. They only cost about $1.25 or $1.50 on average, but it only costs Microchip 50 to 60 cents to make it. So it's a very profitable and, like I said before, a very ubiquitous business, but it's certainly not sexy by any stretch of the imagination.
Texas Instruments, they've been around for a long time. And remind us what devices they make and where you see growth.
Yeah, so it's interesting. These two chips are very complementary. So Texas Instruments' main product is analog and high-end analog. So analog is very similar to a microcontroller, right? It's cost, $1, $2. Anything you plug into the wall, anything that uses electricity is going to have analog there, where you convert like where you plug something into the wall, that energy or the electricity that comes in there has to be converted to whatever the device is. So Texas Instruments is the largest analog company out there. The analog market is I think it's $150 billion. It's a huge market. And for every dollar of microcontroller content that Microchip has, for example, you have $1.50 of analog content that goes around that. These are two of the highest profitability products out there, not just in semis, but in the world. So one of the reasons why we're so positive on Microchip and Texas Instruments is both of their margins are very depressed. Their gross margins have gone down 10 to 15 points because we just got out of a downturn. So naturally, when we have an upturn, they should go up 10 to 15 points. And at the peak, you should have mid-60s gross margins, 40s operating margins for Microchip. You should have 70% gross margin, 50% operating margin for Texas Instruments. So not only are these two companies very profitable, but you also have a ton, in fact, the most upside and the most earnings growth in the entire semiconductor sector. Everybody loves AI, right? We love AI too. To me, it's almost kind of boring, right? We like Broadcom, we like NVIDIA, we like Micron, all these AI plays. But in our opinion, we just put out our 2026 preview. We think that the biggest surprise this year is going to be an analog upturn, analog and microcontroller upturn, which did not have a very good year last year. So that's a change we see in semiconductors this year.
Can we squeeze in your take on Broadcom, though? We've only got about a minute and a half. Sorry about that. What does Broadcom have going for us right now?
Sure. So this is interesting. So we all know that Broadcom is the second largest AI semiconductor company out there. You've obviously got NVIDIA, which is the big kahuna, Broadcom just below them. What Broadcom does is, unlike NVIDIA that does a GPU or a graphics chip that they sell to everybody, Broadcom does custom chips where they work with the company like Google, for example, which is 2/3 of their revenue. They work with the company to do that. They're also engaged with OpenAI, with Meta, with other companies. Now, the big deal here is that Google has been able to sell their sort of custom chip that Broadcom manufactures. They're starting to sell that to different companies. So Anthropic, which is a very sort of famous up and coming AI company, they're buying it. We've also heard, we put this in print, that we believe that Amazon and Microsoft, not only are they doing their own chips, not only are they buying from NVIDIA, but they're also going to buy some of the Google chips. So we think that this is a large growth driver for Broadcom, and that Google is able to sell, they call it a TPU or a tensor processing unit. They're able to sell their proprietary chip to other companies out there. We think that's the next leg of growth for Broadcom. Broadcom also is one of the most profitable semiconductor companies out there. Their gross margins are in the 75% range. It's just, it's pretty amazing. It's how profitable these guys are.
Chris, we'll have to leave it there. That was great. You gave us two relatively under-observed names in chips that we don't talk about much at all. Thank you very much indeed. Really appreciate it. Chris Dangley of Citi, thank you very much for watching The Open. Morning Markets is up next.